Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Park Hotels & Resorts Inc. Annual Report. Park is a leading lodging REIT that offers a diverse range of businesses and services through its extensive portfolio of iconic hotels and resorts. The company's portfolio comprises 38 premium branded properties, featuring over 24,000 rooms, strategically located in prime city centers and resort areas. These properties provide various services to cater to the needs of their guests, including accommodations, dining options, recreational facilities, and more. By offering a range of amenities and services, Park aims to deliver exceptional experiences for its customers while generating value from its significant underlying real estate assets. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to remain stagnant over a period of time. The stability of Park Hotels & Resorts Inc.'s stock price in the past year may be attributed to several factors. One possible reason is that the company has maintained a consistent financial performance, with steady revenue growth and stable earnings per share. This consistency can lead to investor confidence, resulting in minimal fluctuations in the stock price. Another factor could be the lack of significant industry disruptions or changes in market trends that would impact Park Hotels & Resorts Inc.'s operations. The hotel and resort industry is often subject to seasonal fluctuations and economic cycles, but if the company has successfully navigated these challenges, its stock price may remain stable. Additionally, the company's management team and board of directors may have made strategic decisions to maintain a conservative approach to growth, prioritizing stability over rapid expansion. This could involve investing in existing properties, improving operational efficiency, or exploring new revenue streams through partnerships or acquisitions. It is also possible that Park Hotels & Resorts Inc.'s stock price has been influenced by broader market trends and investor sentiment. If the overall market has been experiencing a period of consolidation, or if investors are cautious about taking on risk, this could contribute to a stable but unremarkable performance from the company's stock. Ultimately, without access to specific data or news sources, it is difficult to pinpoint the exact reasons behind Park Hotels & Resorts Inc.'s stable stock price. However, by considering these possible factors, we can begin to understand the complexities involved in maintaining a consistent financial performance over time. Park Hotels & Resorts Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Park Hotels & Resorts Inc. trades at a higher price-to-book ratio of 0.72 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5% while revenue has grown, but assets and equity have declined. This suggests management may be prioritizing buybacks over reinvestment, raising questions about long-term growth prospects. The company have a dividend yield of 8.89%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, operational excellence through active asset management is a key driver, as seen in the comprehensive renovations at Royal Palm South Beach, Miami, and the repositioning of core hotels across brands or chain-scale segments. Additionally, adaptive reuse opportunities for underutilized assets, transformative renovations, and divestiture of non-core hotels contribute to revenue growth. Consumer demand, particularly from group business, is also a significant driver of revenue growth, accounting for 30% of rooms revenue. Occupancy rates play a crucial role in affecting all components of revenues, while trends in leisure travel impact transient demand. Furthermore, expected macroeconomic improvement from deregulation and supply growth, new room supply, impacting RevPAR and profits are other drivers of revenue growth. On the decline side, decrease in occupancy at certain hotels, increase in interest paid on loans, and decrease in interest received due to lower average cash balances contribute to revenue decline. The fixed expenses such as rent, property taxes, insurance, and interest expense exacerbate the adverse effect of revenue decline on net cash flow, margins, and profits. Other drivers that impact revenue growth or decline include sales of properties, gains on sales, earnings from investments in affiliates, distributions from investments in affiliates, impairment losses, and disposition of non-core hotels. These factors demonstrate the complexity of revenue growth and decline, influenced by a range of internal and external factors. Net income for the company decreased significantly in 2025 compared to 2024. The net income dropped by $277 million, a decrease of 7.2% from the previous year. This decline can be attributed to various factors, including uncertainty around the Hilton Honors loyalty program and contractual disagreements with third-party hotel managers. Profit margins also suffered in 2025, with hotel-adjusted EBITDA decreasing by $39 million and core hotel-adjusted EBITDA dropping by $17 million compared to 2024. The interest expense decreased by 2.3%, $5 million, from 2024 to 2025, which may seem like a positive change, but is likely overshadowed by the significant decline in net income. The reasons behind these changes are multifaceted and complex. Increased costs associated with cybersecurity threats, higher compliance costs related to data collection, use, and retention practices, and costs of maintaining brand operating standards have all contributed to the decline in net income and profit margins. Additionally, disruption in accessing capital, increased labor costs due to strikes, union negotiations, and collective bargaining agreements, and potential loss of franchise licenses or brand management agreements have further exacerbated the situation. The company's reliance on third-party hotel managers has also led to uncertainty and decreased profitability. Furthermore, the impact of new non-income tax laws, rules, and regulations, as well as increased costs and risks due to corporate responsibility initiatives, competition from internet reservation channels, and peer-to-peer inventory sources, have all taken a toll on the company's financial performance. Overall, the decline in net income and profit margins can be attributed to a combination of internal and external factors. The company must address these challenges and implement strategies to mitigate their impact in order to restore profitability and growth. The company's financial performance is a positive indicator of its ability to generate cash from its core operations. A key metric that supports this conclusion is the net cash provided by operating activities, which stood at $398 million for the year ended December 31, 2025. This figure demonstrates the company's capacity to produce cash from its day-to-day business activities. Furthermore, when considering other sources of operating cash flows, such as those related to operating leases, we see that these also contribute positively to the overall picture. Specifically, the $27 million generated from operating leases for the same period adds to the company's total operating cash flow. Overall, this suggests a strong ability to generate positive operating cash flow, which is essential for sustaining business operations and investing in growth initiatives. The company's debt level has experienced fluctuations over the past year. Initially, it increased by approximately $3.8 billion at December 31, 2025, due to the addition of a new $800 million delayed draw term loan in September 2025. However, this increase was later offset by a decrease of approximately $3 million from $186 million to $183 million. In terms of interest expenses, there are mixed signals. On one hand, interest expense associated with hotels in receivership decreased from $60 million in 2024 to $58 million in 2025. Additionally, total interest expenses inferred to have decreased as the company's debt level is not mentioned, and interest expense associated with hotels in receivership has decreased. However, on page 52, it is noted that interest expense increased by $27 million. Despite these conflicting reports, a clear trend emerges when considering the overall impact of these changes. The company's debt level has remained relatively stable, with only minor fluctuations. Similarly, interest expenses have generally decreased over the past year, with some isolated instances of increase. The performance of various segments and regions within the hotel industry has been a mixed bag. On one hand, core hotels have struggled, experiencing a decline in revenue and expenses from 2023 to 2024. This poor performance is a cause for concern, as it suggests that these hotels are not adapting well to changing market conditions. On the other hand, non-core hotels initially showed promise, with significant increases in revenue from 2023 to 2024. However, this momentum was short-lived, and they ultimately performed poorly, experiencing a decrease in revenue from 2024 to 2025. In terms of specific properties, some have fared better than others. The Royal Palm South Beach Miami, for example, has seen significant success with over $100 million invested in comprehensive renovations. In contrast, the Hilton Hawaiian Village Waikiki Beach Resort has struggled, with high renovation costs totaling $85 million for both hotels. Overall, it is clear that some segments and regions within the hotel industry are performing better than others. While there have been successes, such as the Royal Palm South Beach Miami, there are also areas of concern, including the poor performance of core hotels and the decline of non-core hotels. The management is signaling a shift in focus towards active asset management, with an emphasis on external growth through strategic acquisitions and disposals. This approach aims to enhance value and diversification by streamlining the company's portfolio. Specifically, they plan to dispose of 13 non-core hotels to concentrate on their core assets. To maintain liquidity and minimize operational costs, the company will focus on its consolidated core hotels. They have established reserves for capital expenditures in accordance with management agreements and debt obligations. Furthermore, they intend to draw upon a delayed draw term loan in 2026 to repay 2 mortgage loans totaling $1.4 billion. The management is also committed to maintaining financial flexibility by balancing cash, debt, and equity. As a REIT, the company will generally not be subject to U.S. federal and state income tax on taxable income generated by their REIT activities. To gauge demand, pricing levels, and profitability, they use key metrics such as occupancy, ADR, RevPAR, EBITDA, adjusted EBITDA, and hotel-adjusted EBITDA. Overall, the company's strategy is centered around optimizing its asset base, managing debt, and maintaining financial flexibility while continuing to qualify as a REIT. This approach aims to position the company for long-term success and growth. Acquisitions and divestitures are crucial components of any business strategy. In this context, we will focus on the acquisitions and divestitures made by a company. The company has been actively involved in acquiring new assets to expand its portfolio. Notable acquisitions include Chesapeake Lodging Trust, the Wade, formerly W Chicago Lakeshore, and the Midland Hotel, a Tribute Portfolio hotel. These acquisitions were made in 2025, indicating the company's focus on growth through strategic purchases. Additionally, the company has acquired a 20% ownership stake in Hilton Orlando, which is included in its core portfolio. In terms of divestitures, the company has been actively disposing of non-core assets to pursue growth and diversification. This includes the sale of non-core hotels, as well as the disposal of certain hotels to free up capital for more strategic investments. Furthermore, the company has disposed of all 13 remaining non-core hotels, demonstrating its commitment to streamlining its portfolio. The company's divestiture strategy also extends to other assets, including the SF mortgage loan, which was defaulted and resulted in a gain of $58 million. Additionally, the company repurchased or redeemed $650 million worth of 2025 senior notes during the second quarter of 2024. These actions demonstrate the company's ability to manage its debt and make strategic decisions to optimize its financial position. The company has demonstrated its commitment to returning value to shareholders through 2 key initiatives. Firstly, it has paid dividends on multiple occasions, as confirmed by various pages in the document. This indicates that the company has generated sufficient profits to distribute a portion of them to its investors. In addition to paying dividends, the company has also engaged in share buybacks. The exact details of these transactions are outlined in specific pages of the document, including the number of shares purchased and the total purchase price. Furthermore, it is noted that these share buybacks were permitted under a credit agreement, suggesting that they were carefully planned and executed to maximize shareholder value. Concerns about inventory buildup or supply chain disruption exist due to the impact of climate change. Changing weather patterns and other physical effects of climate change are causing disruptions in supply chains, posing a significant threat to businesses and economies. This issue is particularly highlighted in reports and studies, emphasizing the need for companies to adapt and prepare for these changes. That concludes the financial summary for Park Hotels and Resorts, Inc. Feel free to comment below, and I will be happy to answer them when possible.